Japan, something historic that happened in Japan could impact interest rates across the world. That's right, Bank of Japan, for the first time in 17 years, moved the interest rate, the average interest rate of Japan, into positive territory. Bear in mind, for all these 17 years, the average interest rate in Japan, the Bank of Japan's interest rate was minus 0.1%. And today, that was moved from minus 0.1% to positive 0.1%, the first time in 2 decades. It's a very important development that could mean a lot for interest rates, not just in Japan, but also all across the world, anywhere from the US to India. But first up, take a look at this.
Japan's central bank ended 8 years of negative interest rates on Tuesday, ringing in a new era of monetary policy in the country. It's the first rate hike in 17 years, but the Bank of Japan is keeping rates around zero, moving cautiously amid the country's fragile economic recovery. Japan is aiming to shift away from a focus on reflating growth with decades of massive monetary stimulus, so the decision was widely expected. Tokyo's central bank is the last in the world to exit negative rates, ending a time where global policymakers used cheap money and unconventional monetary tools to try and prop up growth. The BOJ on Tuesday also scrapped a policy aimed at capping long-term interest rates around zero, known as yield curve control, though the bank said it will keep buying broadly the same amount of government bonds as before and ramp up purchases in case yields rise rapidly. A spike in bond yields would make funding Japan's huge public debt more expensive. The country's public debt is already twice the size of its GDP and the largest among advanced economies. Analysts say Tuesday's announcement will have a very small actual impact on the economy. The central bank is expected to keep monetary conditions loose, and no major hike in household mortgage rates or funding costs are expected. But an end to the world's last remaining provider of cheap funds could jolt global financial markets. After amassing overseas investments in search of yields, Japanese investors may now look to shift money back to their home country.
Right, so it's not just about interest rates, but it's about how it could affect financial markets all across the world. And Karthik, that's the reason why this is a big story, isn't it? Because it's not just the cues it gives to the US FOMC or to Bank of England, but it's about the fact that the cheap money that came from Japan could be invested all across the world. It goes backwards. The money is not going to be as cheap as it was in Japan.
Yeah, but at a range of between 0% to 0.1%, really, do you believe, Krishna, that money will move back into Japan? I doubt it. The Reuters report did mention it. I think there are going to be certain funds, there are going to be perhaps certain bonds in the Japanese government, which may now, thanks to this moving out of the negative territory, coming into positive, move some flow of money back into Japan. But I think the kind of yields which investors expect is not something that, even moving into positive territory and just about into positive territory, is something that that is going to happen in Japan. But I also feel this slight movement from negative to positive is going to have absolutely no impact on the FOMC decision, which is expected to be out tomorrow, simply because inflation in the US has come hotter than expected. So it seems that this whole higher for longer now gets stretched to even longer than what it was anticipated earlier.
Right. Let's get in the expert now at this stage to help us understand what this means further. We have Teresa John, lead economist and head of research at Nirmal Bang, joining us live. Teresa, thank you so much for taking time out to be with us here on Business Plus. The simple question is, how much of an impact does an interest rate in Japan going from minus 0.1% to positive 0.1% will have on interest rates across the world and financial markets as well?
Yeah, so this Bank of Japan decision to move the rates to positive territory, I think, was widely anticipated by the market. So that's why you didn't see any major impact, even for that matter, on Japanese equities. Even globally, I think the wedge between the Japanese interest rates and US interest rates remain quite high. So the US is at 5.5%, whereas Japan is only at 0.1% even after this interest rate hike. So that wide parity remains. So I don't think a lot of money will be flowing out from other markets back into Japan. And moreover, the Bank of Japan has also said that the language is very important to note in the Bank of Japan statement. So they basically say that they will continue with accommodative conditions. which means that they are not they're not looking at significant increase in interest rates from here. They will continue to buy Japanese government bonds, but they will stop buying Japanese ETFs as well as the Japanese real estate investment trusts. And they will continue to buy corporate bonds as well, but probably 1 year down the line, they might stop purchase of corporate bonds. So, given that inflation is moving closer to the target, I think this is just a natural progression. It doesn't seem like they're going for an aggressive rate hike cycle.
Okay. You were also simultaneously looking at the inflation data coming out of the US continuing to remain high. But as far as the year 2024 is concerned, the calendar year 2024 is concerned, all eyes are on whether there will be a US Federal Reserve rate cut. And there is a US Federal Reserve Open Markets Committee meeting decision that's going to be out come tomorrow. So what are your expectations from that?
Yeah, so the US inflation numbers have been slightly higher than expectation, particularly on the core inflation side. But that said, if you look at the real interest rates in the US at 5.5% Fed funds rate, and even core inflation at around 3.2% odd, the real interest rates remain quite high from a US perspective, and we look at it from a historical perspective. So I'm not expecting a rate cut tomorrow at the FOMC meeting, but I think probably in the course of the year, as the dot plot itself has indicated, you will see rates move lower. But what you probably will not get is, aggressive rate cuts. Probably it will be maybe 2 to maximum 3 rate cuts that you will get in 2024, and post that, depending on the inflation trajectory, the Fed will take a call on further rate cuts. So you will have higher for longer rates when you look at it from a historical perspective, but that doesn't mean that rates will probably stay at 5.5% for the entire year.
Hi Teresa, good evening. Karthik Malhotra here from the studio. I just want to understand from you, what does all of this mean for India? What we are seeing play out in Japan, what we will see play out in the US, and also rates coming out expectedly from Bank of England later this week. How does all of this play out for India, given the fact that there is an FTA in the works with the UK? There are some investments that US based companies are looking at making into India, and in any case anticipation of an IT washout year to continue, because US is going to continue to be higher for longer. So how does all of this play out for the Indian economy and India's inflation and the eventuality of rate cuts in India?
So, from an RBI perspective, what the Fed does will have some impact. So, probably the RBI may not front run the Fed in rate cuts. So, I think that to that extent, will have some. What happens globally does have an impact on India, but to to a large extent, India is also looking at its own inflation dynamics, but we're not isolated from the world. So our base case is that, like, the Fed will cut probably by around 50 to 75 basis points this year. India will probably see a shallower rate cut cycle, so a maximum of 50 basis points is what we are expecting.
Okay,
But this,
and
you also need
sure. And I want to understand Bank of England, what are your expectations? Because we've seen 2 straight quarters of negative growth in the UK, which is technical recession. So how do you see the Bank of England moving the needle on rates?
So I think the Eurozone and the UK, if you look at it, they have been the numbers are slightly weaker than in the US. So both in the Eurozone and the UK, you have, I would say, a slowing growth, a technical recession sort of scenario. So probably it could happen that either the Bank of England or the Eurozone could cut rates before the Fed. I see that as a possibility. But I don't think the rate cuts will start, probably at the next meeting. Maybe going into the mid 2024 is when we are probably expecting the rate cuts to start globally.
Okay, and let's come back to India's neighborhood, if not specifically to India. What about Pakistan? I mean, interest rates of 22%, inflation in excess of 32%. I mean, where does Pakistan go from here?
So, I think that's, each country will also have to look at their, what do you say, internal dynamics as well. So, if inflation is extremely high, then the opportunity for you to cut rates, even if global central banks are cutting rates, that will be significantly lower. And I think some of these, like Pakistan, is also dependent on the IMF, so a lot for some support. So I think that will also be dictated by what are the global funding agencies actually kind of advise them to do, because they are reliant on funds from these agencies.
But Teresa, 22%, I mean, what is the cost of capital? What kind of capex and what kind of funding can a state like Pakistan now expect to derive from this very high 22% interest rate? I mean, how many successive rate cut cycles is it going to see to come to some sort of normalcy?
No, so in some of these economies, I mean, you've seen this in Turkey, in even in Brazil, at not at this point in time, but you've seen very high inflation and very high interest rates. Uh, but if you do have some structural programs in place, I mean, the opportunity to cut rates will come at some point in time, and at that point, if inflation kind of moderates quite rapidly, then I mean, each meeting you could cut by 100 basis point odd, or even more. And if you do consecutive rate cuts, you can bring it down to a normal rate. But I think that will depend on inflation, and I think what the agencies like IMF would be advising Pakistan.
All right, so which means that a lot of work needs to be done before any kind of normalcy can prevail in Pakistan, be it interest rates or inflation.